Well, it looks like a federal court is going to unseal at least part of the affidavit that was used in the process of getting the search warrant to raid Mar-a-Lago. But that's going to take like a week. So I'm not going to talk about that today because we don't really have anything new on that other than it's coming. But what we do have today is existing home sales, which is something that I like to follow closely on this channel, especially since we're in the process of the housing market finally collapsing. And for those of us who, it's hard to call myself a housing bear. It's not necessarily that I think, you should short the housing market. It's that I want the housing market to go down. So it's a little different than being just, like a bear. But for those of us who think housing is way overpriced and expensive, this month it's a mixed bag. I'll be honest. Home sales are down 20% year over year. That's the big number here, and that's huge. It's huge, and that is good news because in most markets, inventory is rising. Home sales are coming down. You would think, okay, well that'll translate into lower prices. And 20% year over year drop in sales when inventory is rising, that's huge. That is, I think, one of the biggest drops on record. And we have now 6 months in a row of declining home sales, which apparently is the longest streak since 2013. And 2013 was when we were when the housing market was bottoming. 2012, 2013, that was pretty much the lowest housing prices got, after the last crash. And again, I always want to remind people think that in 2012, 2013, housing prices, oh my gosh, they were, rock bottom, it was so cheap. From a historical standpoint, housing prices in 2012 just came down to normal. They did not get cheap. Housing was never cheap. It's never, ever been cheap. No one who's alive today has seen a cheap U.S. housing market. It's either been expensive or normal. So with that said, what are housing prices doing right now in the face of declining sales, rapidly declining sales, and rising inventory, and rising interest rates? Well, interestingly enough, sadly enough, the median sale price of a house in the United States has risen 10% year over year from around $360,000 in July 2021 to over $400,000 in July 2022. And you could say, well, maybe that's because buyers on the lower end of the market are dropping out, and so the median price is rising because higher end purchases, more expensive homes, what realtors like to call luxury homes on radio ads, those sales are making up a greater percentage of the overall real estate market, and so therefore the median sale price is rising. Buyers are, dropping off the lower end of the housing market, which, I mean, what is the low end of the housing market? 300,000, I guess. That's the bottom, basically, that I've seen, any normal house go at. A really, like a small house in a crappy neighborhood, 300,000. That's about the bottom that I see. And so you could say, well, those houses maybe are sitting on the market and not selling, and the houses that are still selling are, being bought by rich people who are not affected as much by rising interest rates. And I would think that's, that would be a somewhat acceptable theory, but we're being told now that the average house is sitting on the market for no more than 14 days. That's the average now, which is, I think, also a record low. It's lower than it was last year. So think about that. Inventory is up. Housing prices inventory's up, sales are down, prices are up, and time on the market is down. Something here just doesn't add up. If you've got less sales and more inventory, which at least maybe it's because I'm comparing national numbers, and most when I look at inventory, I always look at local metros. I look that up on Fred, particularly the metro is here in Florida. So maybe overall in the overall country, maybe inventory's down. But actually, thinking back to the article, I don't think it's down nationally. I believe national inventory is up year over year. So how is it that these homes are sitting on the market for a shorter period of time than they were last year? That just doesn't make sense. But like the math here, less of them are selling, more of them are on the market. But I have to say that anecdotally, while the data does not add up to me, anecdotally it does sort of ring true, because when I have been looking at the markets, different towns, in Florida here, that's kind of consistent with what I've been seeing. I have not seen huge price cuts. I'm not seeing houses sit on the market for very long, and prices seem to at least be holding their ground, if not rising, which again does not make sense in this current interest rate environment. Now, the National Association of Realtors, they're trying to make the case, okay, well, interest rates peaked in June, and mortgage rates have come down since then, and so they're going to keep going down, and that's going to, and now we're going to be right back on track for another housing boom. The housing crash is over. June was the worst it's going to get. Now that interest rates are, back in the fives, home buyers are feeling flush, and they're going to go drop, $800,000 on a 3,000 square foot house sitting on a 5,000 square foot lot with a 2-car garage that you could fit maybe one Honda Accord and a golf cart inside of, and a driveway that is not long enough for you to actually park outside of the garage without blocking the sidewalk. And blocking the sidewalk with your car, of course, would be against the deed restrictions. So, all in all, what really stands out to me, what doesn't click out of this data, what doesn't mesh and kind of fit into the story, is this figure of average time that houses are spending on the market. I could understand inventory being up, sales being down, and prices still rising if houses were starting to creep up, if they were taking a little longer to sell, because that would kind of make sense. Okay, people are less interested in houses at this price, and so it's going to take a little longer to find a buyer. Instead of taking 2 weeks, maybe it'll take 3 weeks. Maybe it'll even take a month. But that's not happening yet, and that concerns me. But other than that, I look at this data. I look at the Fed saying that they expect to continue hiking interest rates. And I look at the amount of housing inventory that is coming on the market, the amount of houses that are under construction. When I drive around Florida, there's houses being built, in the thousands everywhere. Everywhere you go, you have communities that are doubling and tripling in size. Just if you look at the houses that are currently being built and have been built over the last 2 years, we are looking at an explosion of housing units in this state. Sleepy little back roads that I used to take, without any thought a couple of years ago. Now I have to watch what time I'm leaving, certain businesses or certain places and going to and fro because I'm in bumper-to-bumper traffic. Of course, the increase in traffic would tend to support this massive increase in housing inventory because it would suggest, well, there are just that many people moving here. But as I've said in the past, the people moving here, in my experience, do not move here to work. They move here just to live. I do not know people who work in this part of Florida who can afford to live where they work or can afford to live in any of these, neighborhoods that are being built for the most part. And that to me suggests that our local economy is not what's fueling this real estate boom. It's not that people are being attracted here because our economy is doing so well and they're, taking high-paying jobs here, and that's why people are bidding up the price of housing. People are coming here with money. I've said this for years, and taking this out of this hot money, which is what you would call it in sort of a in international finance context, I believe. And this hot money is flowing in here, rapidly inflating our housing prices. But when the going gets tough, that hot money can leave just as quickly as it came. And as asset prices more broadly, not just real estate, but stocks and bonds, begin to crater, which the stock market crash has been paused and been rewound actually quite a bit lately. There was another big rally in the stock market, but that rally, of course, is ahistorical. It is not consistent with the Fed hiking rates in the way that it has. Historically speaking, I think we can be about 90% certain that asset prices in just about every class, risk assets, I should say, every class of risk assets have peaked. Even if they are going up a bit in the short term, I don't think that they're going to make new all-time highs in the case of stocks and bonds and the like. And so it may be that in order to really cement the real estate crash, we are going to need the stock market crash to come first, which is the opposite of how things were back in 2008. The real estate crash came before the stock market crash. But back then, the market was not being driven so much by cash speculators, people who were chasing yields. That was not what was driving the housing bubble back in 2006. That was being driven by liar loans and, yes, speculators, but speculators who were, again, taking out loans. It was, a bank credit, very classic, Austrian business cycle kind of story. And so while mortgage rates are crucial in 2022, they are not as all-encompassing as they were back in 2006. So with that said, I will see you folks back here tomorrow.